Hey everybody, quick disclaimer, this is not investment advice. This does not mean I am advocating for or against any position. This has nothing to do with any of the funds I manage or my own personal funds. Okay, so jumping into this. So first off, looking at Bitcoin. Bitcoin being quite an interesting one. I mentioned it a couple times in the audio note that I really like the range Bitcoin is in. And why we're recording this right now, we're starting to finally break out of that zone. This is a high volume node. Basically, old school traders used to do kind of a similar thing where they would go, okay, well, I'm gonna look inside of a range as whichever has the most bars, that's what I'm going to kind of look to get over. And when we get over that, that's when I'm going to buy. Nowadays, we can kind of see that by using something called volume by price. So right here, we're seeing that the most buyers were in this area. We're starting to get over that. A nice close over the same level I've been talking about, which is 20,500, would give a buy signal. This thing could absolutely rip to the upside. Volatility is incredibly low. Where's the Bollinger bandwidth? That's really hard to see. 1 second. All right, here's Bollinger bandwidth. So we're seeing that this is incredibly tight. Like the bands are incredibly tight here. We can even go back a little bit. You know, the last time we've seen the bands this tight was probably before the big run in 2020. So bands are extremely tight, possibly ready to rip to the upside. That would say a lot about the risk appetite of the markets at the moment. So let's keep an eye on this one, see where it ends up at, and we'll go from there. The volume got all messed up because I moved it, but that's just how that goes. But we're talking about this general pattern here. This is where the volatility is dropping. This is where we're kind of seeing this kind of bottoming triangle type pattern, squeeze, and then break out to the upside. Safest bet would also be to buy over it. Once again, its buy signal would be around 20,500. Add signal or another buy signal would come if we get over this 25,000 area. So we'll see how that goes. So the S&P had a very interesting bottom that other day. And I kind of wanted to point to this just because it was extremely interesting. So if we're looking at the S&P here, we opened down to almost 2.5%. Then we have this crazy rally, 3.32%, huge move to the upside. And basically it creates a huge range day, 5.8%. I love these bottoming patterns, and nothing tells me more about these bottoming style patterns than this. We hit this bottom. That was a low. We took out the June lows, and instead of just breaking down like we should have, honestly, that's what would make sense in a pattern like this. We immediately reversed and went to the upside. I call that the oh shit pattern, the oops pattern, people call it. There's a million names for it, but basically it's the market participants decided this was too low and bought the crap out of it, and it keeps rallying to the upside, and it's rallying more today. This is an old shot. I talked about some of this in the first Zoom meeting we had, but I really wanted to point out this range day because that was extremely interesting. Also in that Zoom meeting, that this was obviously a week and a half ago, I pointed out the buy signal on one of my models also kind of came in. It's a short-term signal. It's not a long-term, not something I'm saying buy the bull market forever or anything. It's we sell signals, buy signals, and so on. So we could possibly see some more upside in the broad market. People might not remember, I haven't been bullish equities or anything broad in this market for a very long time. This to me actually looks like a good, more than just a bear market rally, and something that you'd want to take a shot at because it might be more. But once again, I wouldn't rule out just a move to the upside and another smackdown. So you have to be careful here either way. But every trade there's got to be caution on every single trade. Somebody posted some information about market bottoms in October. I went back and back tested that, looked over it, finding out that there was a lot of market bottoms that happened in October, and that was absolutely right. 8 in the Dow Jones Industrial in all of the bear markets. So the Dow Jones Industrial is the seasonality. And so why we use Dow for seasonality sometimes is not because I like it as a better indicator of the broad market than the S&P. Use the Dow mainly because there's more information. It can go back further in the Dow than the S&P 500. So when we're looking at the Dow, we're seeing that there's a lot of bottoms that happen in that September, October area in general. This is every year, the normal average of seasonality. Midterm years, for midterm election years, this is how seasonality usually looks, which really was pretty spot on for how this year went. Big drawdown, flat, terrible summer, smackdowns in the early summer, August rally, and then going back to the downside. I really like when the market is kind of following a good path on seasonality. That kind of tells me that it's going to continue to follow this path, and we can kind of create a nice roadmap from that. That doesn't mean that, buy based on this one thing. That means that if you start to get buy signals on these things, you might have some extra conviction towards the end of the year into a nice rally. So we'll see. Most of the time, the market has these nice rallies into November, December. But once again, there's a lot of fundamental headwinds out there. So we have to keep an eye out for either those shifting or if those are staying the same. And we need to kind of keep an eye on that because that's going to really move the markets one way or the other. It could put an end to this very quickly, or it could let it go. All right, so I also went through this something called the bicentennial pattern, and it's about market bottoms. So, sorry, not market bottoms. Years ending in two. So all these years ending in two, they basically, the way the theory goes is that they're similar patterns. And that doesn't mean, I think so many people think of cycles and they're like, oh, look, it doesn't look identical to this. Like nothing's ever going to look identical. That's impossible. The people who overlay charts with other charts and all that crap, it's garbage. That doesn't tell you anything. Every single person's overlaying, 2008 right now and going, look, it's 2008. Like it's just not that. I wish it was that easy. It just isn't, and people do a lot of chart crimes with that stuff. Basically, you can remold those however you want to make them look similar or different, whatever you want. And they curve fit the crap out of that information. But basically, looking here, we have this bottom into fall. This is early November, and then we see kind of a rally close to year end, and that was 2012. Here's 2002. 2002, similar pattern. Market gets this nice kind of spike bottom, rallies into December, a little bit of a drawdown into the end of the year, but nice rally in the meantime. That was 2002. That's also 2002, 1992. Bottom in October again, massive rally into the end of the year. This is 1982. So if you remember 1982, this is when we came out of the craziest inflation ever, crazy high yields. The market was in a bear market for many, many years. I think it was its late 60s to early 80s. And so basically we came out, had an actual bottom here, but we pulled back into October. At the beginning of October, we rallied again and chopped to the upside to the end of the year. 1972, another market bottom in October. Now, once again, these aren't market bottoms as in the normal sense of like, hey, this is a bear market bottom. That's what the first back test was on. This is a market bottom as in pullbacks, corrections, whatever you want. Basically, this is kind of what we're seeing. So we get a nice pullback here. October happens, spike bottom, rips back up to the upside. 1962, which looks very similar to today, a little bit different, actually very, very close. Even the month is very similar to the bottom to bottom. So we get another bottom. This is in the S&P. Basically come back up, that rally into August. It ends up drawing all the way down into October. Sounds familiar. And then we rip to the upside, flatten out to the upside to the end of the year. And 1962, similar pattern once again, market bottom ripping to the upside in October. And that one's kind of late-ish October. these are all very normal patterns. I know that that seems like, like hocus pocus or some bullshit basically, but like this is something that happens seasonally most years. There's many reasons for seasonals. You could go across the board. They will change with time. They'll go in different ways, but this is a very interesting seasonal pattern. It happens quite a bit. And market bottoms to rallies into the end of year are also a thing that happens a lot as well. Material sector seasonality. So now as we're looking at the material sector seasonality, that's one thing to kind of point at. The materials, industrials, they actually usually have the best seasonality into the end of the year. They're usually the best outperformer. You see here, this is they're usually not the best outperformer in the summer. That's usually tech. But once we get into that October area, we get a good rally. Small caps are also another one that's a good end of year rally as well. XLB, which is a materials ETF, seeing the relative strength kind of tick up here, get up and over the MA. 200 day or 200 week MA comes up, bounces off of it, moves back to the upside. Wood, another ETF. And once again, like you see ETFs, like I don't really go through individuals as I trade futures. But if you want to find individual stocks in these areas, there's lots of them that could be good to look at as well. Also having good relative strength in also the same sector. So we'll see where that ends up. Steel is one of the strongest ones, showing the most relative strength. It's the same thing over and over again, but some of these things that are putting in a higher low and are still really outperforming the S&P, these are the areas you want to be. These will be the leaders of the next rally. And so that's an interesting one. XME is also an interesting one. So keep an eye on these things as the year goes on. So the S&P today, same thing we talked about earlier. Big outside reversal day. That's where you have that huge candle here. The upside, it actually closed over the 10 in one day, which is wild. I don't know if I've ever seen that before. And now we're moving to the upside. We gapped up and over that 40-day MA. Very good sign of a possibly stronger market to come. And so end of year stuff, we can look at some of these and just kind of get an eye what we're trying to see seasonality wise. Corn, really good rallies towards the end of the year. Platinum is another one. Bottoms towards the end of the year in October, rallies into the end of the year, usually big rally into the beginning of next year, as with most of the precious metals. Cotton is another one. Big rallies into the end of the year. It's been a very tough market to figure out. I'd be very cautious trying to trade this market right now. Cotton is basically you need to be looking really at the Chinese opening to see what's going to happen with cotton. But once again, usually has a really good rally at the end of the year. I just watch for opportunities, not just put on a trade, but watch for opportunities. Palladium's another one I like into year end. Palladium kind of here usually likes a bottom, make a nice break to the upside and continue. And that's same with most of these precious metals. They all follow kind of a similar seasonal pattern. Copper could be another one. Silver, lumber has a great seasonality coming into year end. Probably the best. It's usually a great trade. 67% of the time is the win rate. It goes up 7.4%. Same thing with December, even higher win rate, 73%. So we'll see where that ends up. But lumber could be a very good trade into the end of the year as well. Soybean oil is one I like a lot here. Soybean oil, we're basically kind of looking at these really interesting commodities that have all held up relatively well considering how strong the dollar has been. So keep an eye on this. But this could be another good one to take an eye on. This could definitely move to the upside. The energy sector is also a good mover to the upside towards the end of the year, but it's not usually the outperformer. This year, it could be the outperformer considering it's been the outperformer for most of the year. Still the outperformer coming into right now as well. And also, I got the data off these. I bought the equity clock mainly so I could use the data for back testing, which has been pretty cool experiment lately. It's worked out pretty well. Soybeans, also good one for year end. And most of the time with seasonals, we're not saying to buy things. We're looking at, hey, maybe you could look at possibly looking at a buy signal on these. Maybe it's time to start thinking about buying. Maybe it's time to, look at your fundamentals and see it. I don't know exactly how you trade. For me, waiting for the right signals and the right opportunities to come is what I do, but everybody's going to be different. Lean hogs, that's one that I thought was going to have a much better summer. It wasn't a bad summer, lean hogs and live cattle, but they were a little bit flatter than I would have expected. But seeing here that we definitely could see one more rally into year end. And why I bring that up is the fundamentals on that are crazy right now. There's so much upside in a lot of these commodities because there really are, everybody's kind of way under supply. Once again, this is, these markets aren't just run on supply and demand. There's also a liquidity feature, and as the dollar is really strong and all these things are happening, it's going to be a tough one to get figured out. But once again, things are always shifting, and we got to keep an eye on that and how they're shifting in these markets. So the euro is the inverse of the dollar basically, and this is looking a lot better, looking a little bit more like a bottom. Had that massive breakdown, we got under a dollar parity. I could see this moving to the upside and having a rally here. They're coming in finally and trying to do things to support the euro, support the pound, support the yen. This is going to start putting a lot of pressure on the dollar. The dollar, even though this is on stock charts, they don't update the charts until end of day. But today we broke down under this 40-day MA, finally in the dollar. So kind of looking at it here, seeing if that's a lower high and a possible reversal pattern. All possible. Wouldn't bet on anything just yet. It's just, that could just be a consolidation, could go sideways here and then go back up. But it would make sense based on how the year end is looking and how all of the signals are looking otherwise, that the dollar gives some way here. We get to make some of this rally back, basically we pull back a bit. I'm not looking for the dollar to really come down anything crazy because, most people are it's going to zero or it's going to a million. For me, it's I could see it coming down a bit into year end, coming into its normal time of the year for doing that as inflation possibly the numbers start to come in. It's not that inflation is really going down, it's that the numbers are so extreme now that now we can finally say, and I haven't said this yet, that I'm now finally looking at these numbers for inflation to stop being so hot. I don't know exactly how the Fed is going to make this work, but I wouldn't doubt coming into year end, possibly the election and so on, and the things they said before going on Fed blackout day, or their blackout period, makes me kind of think that they're kind of looking at this as possibly a period for a slowdown, maybe kinder words, it's kind of talking about the possibility of, hey, we're not going to just continue to raise forever. We're going to be a little bit more data dependent or something. Once again, that's speculation, not betting on that. The Fed is surprisingly really just, sending it, and really they have to take care of this inflation problem. So I wouldn't be that surprised if they continue to just raise rates any way possible. But I think what they're looking for is an excuse, and they haven't had one yet. And right now, if everything is exactly how we think it is, there could be a time for an excuse at the moment. I don't think it'll be long lived though. So, either way, it's not something to get your hopes up about. If, for example, they come in and they say, hey, we're gonna stop, we're gonna pause. Like everybody's talking about rate cuts. I really would be really surprised if they rate cut. They're not gonna do that. If they come in and pause, I think that's the possible best case scenario. I think the real case that I would expect is another raise of 75, um, and then different language. We're gonna be more data dependent. We're gonna do this. We're gonna do that. That's what I would expect from the Fed. I wouldn't expect any more than that. Possibly going to a 50 basis point cut. That would be it. But for now, the dollar is of a lot of importance because it's the reason why the U.S. is still in such a strong place. And we're basically in a place where our inflation isn't killing us. And that's because the dollar is so high. We'd be at probably 20% if the dollar was a lot weaker. But with the dollar so high, it's definitely keeping us afloat. And we'll have to kind of see how it goes from there. But looking at this and the fact that the world is usually very adamant about taking out the dollar every time it rises. I mean, if you've been trading for a little while, let me get some more time on that. You'll remember some of these periods, basically the dollar gets here, dollar wrecking ball, the end of the world with the dollar. Everybody was really worried about the dollar going so high and killing everybody and export prices and so on. That this is when they started the reverse repo and then came into here. Same thing here. Oh my God, trade is destroyed, everything's over. And then boom, comes all the way down. Now we're rising so much, we're only starting now to talk about these currencies. Like the pound only recently started to talk about needing strength in the pound. Japan's recently talking about it. So there hasn't been any pressure on the dollar this whole time. And most of the time people are going, okay, well, in the US at least, they're going, okay, well, at least this is keeping inflation a little bit lower. So there was no reason to kill it until now, and it's not that we're killing it. It's that other people might come in and start trying to do something to it. But if that's the peak for now, that wouldn't be very uncommon. That would make sense at the moment. So we'll need to see how that goes. But I really like the idea of kind of how all of these are coming together at the moment. Also, if you haven't seen the video with Mish, that was pretty interesting, looking for inflation in all the wrong places. It was kind of funny, kind of interesting, her new thesis. So you're gonna want to check that out if you get a chance. Not that I always agree with everything anybody says on there, so don't hold me to that. But I'm just saying it was entertaining. Okay, so looking at the overall charts, we're looking at year-to-date sectors. Why crude's on there? Sorry, let me take that off. So crude being there, this is XLE here, 62% still. XLP down 6.12. So basically the next up 62% for energy, down 6.12. And the thing is, for this year, everybody, if you have a flat year, you have a slight loss or a slight gain or a gain, you should be very happy. Most of the hedge funds also, if you look at lazy portfolio ETFs, I think is the name of it, you can go through strategies and you can see that, and also the real number is 95% of hedge funds lost money this year. It was a very tough year for most people. So it's not that it's a down market, it's that it's trendless. It's basically chopping around for most of the summer. Q1 was fine because of the commodities holding it together, but everything else kind of came down right after that. It's been a tough year for most people. So if you're kind of in that area where you're not really getting hit that bad, congratulate yourself, because it's been a tough year. And you're one of, you're one of a small few. Everyone I talk to that's a friend of mine who has a fund, they're hurting pretty badly right now. But things always change. There's always more to come, and things will always get brighter. It doesn't rain all the time. So looking at this, Solicitation Energy is the leader. Obviously, it's still I've had a post on Twitter. If you don't follow me on Twitter, you should. There's a good break to the upside in energy out of kind of a triangle pattern. Looks good. And I'd expect some of these sectors to kind of start to take over a little bit, basically like financials, XLI, as some of the bank earnings came out pretty good. So looking at these things, I'd be very interested to see how these go. The commodities sector is another one. Let's look at year to date. Year to date, we still got some good ones. That's coal. Coal looks pretty good. Heating oil, 71%. Natural gas, 51%. So some of these things are still up on the year, even though they've come back a lot. The things that are down on the year, cotton, copper, and that's the only things that are down a lot. And then you got gold, silver. So some of these things that are precious metals haven't done very well this year, but mostly everything else is still holding up pretty good for the year. Soybeans are up, cattle, feeder cattle, crude oil, that's Brent crude, gasoline, natural gas, heating oil again. These things are holding up in some ways, so that's something good to kind of keep an eye on, try to understand, and try to, get a sense of what you'd be looking at for the next year, the next quarter to end the year. A lot of these things have rallies in the year end for many reasons, and not to mention with all the fundamental data that's coming out about the crops and so on. We have a lot of reasons to think that there's some good opportunities in these into year end. Um, and also, most importantly, the dollar. If the dollar really starts to come off, and I think that's the thing we need to watch over everything. And for me, that's going to kind of govern everything. Am I going to get out of positions? Am I going to keep positions? If the dollar is going to hold up in any way and start to rip back to the upside, that's something that's telling us some serious information. So, right now the dollar topped at around 115. Today it's down to uh, just under 111 into 110. So I mean that's a pretty big move down in the dollar. In the meantime, we'll have to see how that ends up. And then kind of getting into year end, just keep an eye on these things, figure out what you want to do, and stay safe out there, everybody.